All right, let's talk about one of the biggest and maybe sneakiest wealth killers out there today, the way we buy our cars. You might think, hey, a long-term loan makes that dream car more affordable, right? But what if I told you it's actually a trap? A trap that's specifically designed to keep you from ever building real wealth.
So let's just start with a number, and it's a big one. Over $700. That is the average monthly payment for a new car right now. Just think about that. That's a huge chunk of money leaving someone's bank account every single month. And for how long, you ask? Oh, we're not talking about a couple of years. People are signing on the dotted line for loans that last 7, sometimes even 8 years. I mean, seriously, think about that. That's almost a full decade you're committed to paying for something that's losing value every single day.
It really makes you stop and ask, is this a purchase or is it a prison sentence? Today, we're going to run the math and show you exactly how this one decision could be the main thing holding you back from a wealthy future.
This all leads us to what I call the 84-month debt warrant. You see it everywhere. It's become the new normal. But listen, this is not a tool designed to help you out. It's a financial trap, plain and simple, built to make the lender the most money possible. And boy, is it effective. So how on earth do so many smart people get caught in this? Well, it all starts with a very simple, very clever psychological trick. It's called the monthly payment trap, and it is the oldest, most reliable move in the car dealer's playbook.
The dealer leans in and asks that magic question. So, what are you looking for in a monthly payment? The second you give them a number, any number, you've lost the game, because what you're hearing is about affordability. But what they're really asking is, how much total interest can we squeeze out of this person over the longest possible time? Once they have your number, their goal is incredibly simple. Just stretch the loan out, stretch it to 84 months, heck, maybe even 96 months. By doing that, they can make almost any wildly expensive car seem like it fits into your budget. It's a magic trick, and your future wealth is what disappears. Okay, so let's get into the nitty-gritty and see the actual damage this causes. We're going to look at the hard math of 2 totally different futures, all hinging on this one decision. Let's take a $50,000 truck. Super common purchase these days, right? Well, when you finance that thing for 84 months, guess what? You don't pay 50 grand. By the time you're done, you've paid closer to $70,000. That's 20 grand in pure interest. Poof, gone forever. And here is the part that just hurts. After 7 years of making those payments, you shelled out nearly $70,000. And that beautiful truck you bought, it's now worth maybe $15,000. You have literally vaporized $55,000 of your own hard-earned money. It's no different than just setting it on fire. This quote just says it all, doesn't it? A 7-year loan on a car that rusts in 10 years isn't financing. It's financial suicide. You're basically promising to pay for something long after its useful, valuable life is already over. It's just bananas. Now, check this out. Let's look at the 2 paths your money could have taken. In path A, after 7 years, you've got a paid-off truck worth about 15 grand. Okay, but what about path B? What if you bought a cheaper car and invested that same monthly payment? In 7 years, you could have nearly $100,000 working for you in an investment account. That's the real choice here, a resting asset or a wealth-building machine. But you know what? The damage doesn't even stop with just one bad decision. Oh no, the 84-month loan is designed to lock you into a vicious, repeating cycle that keeps people broke. It has a name, the negative equity cycle. First, you got to understand this term underwater. It sounds dramatic, but it's a simple and frankly terrifying concept. It just means you owe the bank more money for your car than you could actually sell it for today. You have negative equity. You are in a hole. And here's how that debt spiral works. You get that 7-year loan. The car's value drops like a rock the second you drive it off the lot. Pretty soon, you're way underwater. But a few years go by, you get the itch for a new car. You go to trade in the old one, but you still owe, let's say, 5 grand on it. The dealer just smiles and says, no problem. We'll just roll that old debt right into your new loan. So you start off your next loan already thousands of dollars behind. It's a trap that resets itself. Okay, I know, that was a lot of bad news. But here's the good news. There is an escape plan. There's a simple, clear, and totally actionable way to avoid this trap for the rest of your life. It's called the 23-8 rule. This is your new guideline for what you can truly afford. It's super simple. First, you put at least 20% down. This helps you fight off depreciation from day one. Second, never ever finance a car for more than 3 years. That's 36 months. If you can't pay it off by then, you can't afford it, period. And finally, your total car payments shouldn't be more than 8% of your gross monthly income. This keeps your car from eating your financial future. And if you want the ultimate strategy, the real power move, just opt out of the whole system. Save up your money and buy a reliable, used car with cash. No payments, no interest, no bank breathing down your neck. It might not look as flashy in the parking lot, but like the old saying goes, drive a beater, live like a king. So at the end of the day, it really all boils down to one simple choice. Do you want to spend your money trying to look rich at the stoplight, or do you want to use your money to actually truly be rich? The choice is all yours.